Have you ever wondered how multinational corporations seem to pay almost nothing in taxes while you're handing over a significant chunk of your income every year? The answer lies in a complex web of international tax strategies that most people never hear about. Today, we're pulling back the curtain on these financial maneuvers that could potentially save you thousands or help you understand how the global tax game really works. What I'm about to share with you isn't just theoretical knowledge. These are real strategies used by businesses and individuals worldwide to legally minimize their tax burden while staying completely within the bounds of international law. By the end of this video, you'll have a completely different perspective on how taxes work across borders and maybe even discover opportunities you never knew existed. Let's start with something that might shock you. Did you know that some of the world's largest companies pay effective tax rates as low as 2 or 3%? Meanwhile, the average person pays between 20 to 40%, depending on their country. This isn't because these companies are breaking the law. They're simply playing by a different set of rules that exist in the international tax landscape. The foundation of international tax strategy rests on one simple principle: tax authorities can only tax what happens within their jurisdiction. This creates opportunities when you have income, assets, or business activities spanning multiple countries. Each nation has its own tax code, and the gaps between these codes create what tax professionals call planning opportunities. Consider the concept of tax residency. Most people assume they're automatically tax residents of the country where they were born. But that's not necessarily true. Tax residency is typically determined by factors like where you spend most of your time, where your economic interests are centered, or where you have your primary home. Some countries use a day-counting test, others look at your center of vital interests, and some combine multiple factors. This creates the first major strategy: residency planning. By carefully structuring where you live and conduct your affairs, it's possible to become a tax resident of a country with more favorable tax rates. Countries like Monaco, the United Arab Emirates, and several Caribbean nations have zero or very low personal income tax rates. However, this isn't as simple as just moving there for a few months. Effective residency planning requires genuine substance. You need to actually live in your chosen jurisdiction, conduct real business activities there, and often make significant investments. Tax authorities worldwide have become increasingly sophisticated at detecting artificial arrangements designed solely for tax avoidance. The second major pillar involves corporate structures and where businesses are incorporated. This is where things get really interesting. A company incorporated in Ireland might have its management in Bermuda and conduct most of its business in Asia. Each jurisdiction only taxes the portion of income connected to activities in their territory. This leads us to transfer pricing, one of the most powerful tools in international tax planning. When different parts of the same corporate group are in different countries, they charge each other for goods, services, and intellectual property. By adjusting these internal prices, companies can shift profits from high-tax jurisdictions to low-tax ones. For example, a pharmaceutical company might develop a drug in the United States, but transfer the intellectual property rights to a subsidiary in Ireland. The Irish company then licenses the drug back to subsidiaries worldwide, collecting royalty payments that are taxed at Ireland's favorable rates for intellectual property income. Tax treaties form another crucial component of the international tax puzzle. These agreements between countries are designed to prevent double taxation, but they also create planning opportunities. A treaty might reduce withholding taxes on dividends, interest, or royalties between two countries. By routing transactions through treaty jurisdictions, significant tax savings become possible. The Netherlands has become particularly popular for this purpose. Dutch holding companies can often receive dividends from subsidiaries worldwide with minimal taxation. then distribute those dividends to their own shareholders with favorable treaty treatment. This creates what's known as a conduit structure. For individuals, offshore banking and investment structures offer similar opportunities. While the days of secret Swiss bank accounts are largely over due to international information sharing agreements, legitimate offshore structures still provide benefits. These might include asset protection, estate planning advantages, and tax deferral opportunities. Offshore investment funds represent one area where individual investors can potentially benefit. Some jurisdictions allow investment funds to operate with minimal taxation, meaning the fund doesn't pay tax on its investment gains. Investors only pay tax when they receive distributions or sell their fund shares, potentially deferring taxation for years or decades. However, this landscape has changed dramatically over the past decade. The Common Reporting Standard now requires financial institutions in over 100 countries to automatically share account information with tax authorities worldwide. The days of hiding money offshore are essentially over, but legitimate tax planning opportunities remain. Cryptocurrency has introduced new complexities to international tax planning. Different countries treat digital assets very differently for tax purposes. Some consider them currency, others treat them as commodities, and a few don't tax crypto transactions at all. This creates arbitrage opportunities for sophisticated investors, though the regulatory landscape is evolving rapidly. Digital nomadism has also created new planning possibilities. If you can work from anywhere, why not work from somewhere with favorable tax treatment? Countries like Portugal, Estonia, and Barbados now offer special visa programs designed to attract remote workers, often with significant tax advantages. But here's where things get complex. Most developed countries have anti-avoidance rules designed to prevent their citizens from escaping taxation too easily. The United States taxes its citizens on worldwide income regardless of where they live, though foreign earned income exclusions and tax credits can significantly reduce the burden. Controlled foreign corporation rules in many countries require residents to pay tax on their share of profits from foreign companies they control, even if those profits aren't distributed. These rules are specifically designed to prevent people from parking income in low-tax jurisdictions. The key to successful international tax planning lies in understanding that substance matters more than structure. Tax authorities worldwide are increasingly focused on where real economic activity takes place, rather than just legal structures on paper. This means genuine business operations, real employees, and actual decision-making need to occur in your chosen jurisdiction. Professional guidance becomes absolutely essential when venturing into international tax planning. The rules are incredibly complex, constantly changing, and the penalties for getting it wrong can be severe. What works in one situation might be completely inappropriate in another, depending on your specific circumstances, the countries involved, and your long-term objectives. Looking ahead, international tax planning is becoming increasingly challenging as governments worldwide coordinate their efforts to prevent tax avoidance. The OECD's Base, Erosion, and Profit Shifting Initiative has already closed many traditional planning opportunities, and more changes are coming. Digital services taxes, global minimum tax rates, and enhanced information sharing between tax authorities are reshaping the international tax landscape. What worked 5 years ago might not work today, and what works today might not work 5 years from now. Despite these challenges, legitimate international tax planning opportunities continue to exist for those willing to do the work properly. The key is focusing on genuine business substance rather than artificial structures, working with qualified professionals who understand the evolving landscape, and maintaining full compliance with all applicable laws and reporting requirements. Remember, the goal isn't to avoid paying all taxes, but to pay the right amount in the right jurisdiction while achieving your broader financial and lifestyle objectives. International tax strategies can be powerful tools, but they require careful planning, ongoing maintenance, and a commitment to staying within the bounds of international law.